Hello and welcome to today's quick intraday video called Yields versus Tech. Let me prepare you briefly for the progressing session. I hope you are already familiar with the daily article and the substantial tweets within my feed, either on Twitter or on Telegram channel. So let's move into stocks. We got, in spite of today's rich stock market section, altogether 3 charts commented is being reserved for subscribers. Let me briefly, very briefly on the surface, walk you through what I have either shared in advance of today's economic data releases on Twitter and within the introductory part, long introductory part to today's analysis. So, I anticipated buying spike reaction to today's data and especially for consumer confidence not to sink stocks. That has happened. Stocks are catching a bit. Initially, tech was sent sharply lower and the riskier elements in line with yesterday's rotation, strong rotation into non-tech, had been outperforming. Now tech is somehow catching up at the expense of non-tech sectors, and virtually everything apart from healthcare is in the green. However, the full index gains are limited and no meaningful technical resistance had been broken. You may remember from yesterday's video that I mentioned 4385 and 4415. I hope you are familiar also with yesterday's videos that I'm preparing practically on a daily basis, and just subscribe to the channel, keep liking, commenting, talking, whether on YouTube or on Twitter, much appreciated. For now, for today, we are seeing rising long-dated yields, and that's been what's behind the tech wobbling today. And we are likely to be increasingly seeing that as central banks around the world, with the exception of Japan, of course, I would say, are not really in a loosening, pivoting mode. Be it Swiss National Bank, Bank of England, European Central Bank, and market is getting discounted the view that the Fed might hike by more than 2 hikes still this year. That means we are in an environment of shrinking liquidity, which is as well something that I covered within Sunday's extensive YouTube video and Sunday's extensive analysis, so make sure you are familiar with both. And no matter what today's data are signaling, recession hasn't been banished, avoided, and excuse me for the typo, even if data come optimistic, which they did, however they would deteriorate throughout the summer. So let's move into precious metals. We are seeing them actually quite under pressure. That means especially gold. Gold is the candidate to be brought down from this high-patched situation. Same thing applies to platinum, and the targets given 1920 and 2220, perhaps 2240, are still within reach in either gold, respectively silver. Next comes crude oil and copper. West Texas didn't act yesterday on the energy sector strength, and is still consolidating around the precarious $70 support. The more time it spends there, the more dangerous the situation becomes, especially over the upcoming 1 to 2 weeks. This week I'm not expecting a breakdown targeting mid-60s or even 68, 67. That should be safe. Why? The high spread to Brent of over $5, that's quite unprecedented, and that's a bullish factor, not merely a caution. As regards copper, I'm looking for it to consolidate in the high 370s, and due to the overwhelmingly positive stockpiles, mining and green economy needs, I'm not looking for a sustainable decline to and below $372 support level. And I remain bullish as much as precious metals, that much copper as well, for the second half of 2023, when we would see, based on the incoming economic data, that recession is still a trouble and inflation is again rearing its ugly head, and that means stagflation. That's the reality. That would be apparent to the mainstream before Christmas, well before Christmas. For sure you are familiar with my daily analysis published every day on my site, including intraday updates for premium subscribers. You know me very well from Twitter, very active feed. The same goes for Telegram. Please use Telegram for getting timely notifications every single time I tweet anything of substance. Here you have the addresses. Remember that site terms apply. Beware also of impersonators. And the obligatory disclaimer. Let me know your thoughts about real assets in the comments section. I'll gladly interact with all of you on YouTube as well. So thanks again for subscribing, commenting, liking, and have a nice day.